Hi, this is Lee Thurburn, and this is the second in a series of videos on funding and financing for your business. We're going to pick up where we left off and start talking about partners. So we previously have talked about starting with you need to have your own capital and then going to your friends and family. The next sort of level of expansion of your marketing efforts could very well be towards partners. Now, partners are people, and I don't necessarily use the legal definition of the word partner. I'm using the word partner here to describe a person or people who actually both invest their time and their active participation, their money and their active participation, so time and money in the business. They want to get involved. They want to roll their sleeves up. They want to help you make the sandwiches or clean the floors or, dig the ditches, so to speak. Whatever it is that your business is doing, they're actively wanting to get involved. And they bring both money, talent, and time to the equation, which is good because having additional people that are fully invested in the success of the venture is a great additional asset for you to have when you're trying to get a new business off the ground. The only downside is that you have to share both decision-making and profit participation with the person or people that you invite to be your partners. And so it's really important that you have a partner agreement in place that allows you to have procedures for how you're going to handle conflict situations, because there is absolutely positively going to be a point in time when conflict situations come up. Now, you could very well do the quote-unquote partner through a corporation. I'm not by any means saying that a partnership as a legal entity is the way that you deal with partners. Partners can also be the people that are additional shareholders or membership members for an LLC in the entity that you have set up to actually contain the business and the business assets. But from an interpersonal relationship basis, partners are people that, regardless of the enterprise structure, they share money, time, and decision-making authority with you. So it's really important that you make sure you have specific agreements in place for how those decision conflicts that are inevitably going to come up get resolved. Now, the next source of funds I want to take us to is crowdfunding. And crowdfunding is a relatively new dynamic. It's certainly new as of the age of the internet. Everything else we've talked about has been in existence really for a pretty long time. But crowdfunding is new and it continues to evolve. There are a number of different kinds of crowdfunding, but the important thing to kind of keep in mind is that generally speaking, crowdfunding accesses large numbers of people who individually typically invest relatively small amounts. Now, crowdfunding can be broken down into 4 types: rewards, cause, debt, and equity. We're going to talk briefly about each one of those, and then we're going to talk a lot more about equity as we go along. So rewards-based crowdfunding is represented by websites like Indiegogo and Kickstarter, where you offer a product. And so a typical situation would be something similar to this. You might be a band, you want to produce a CD, you're a profitable organization as a band, meaning that you make enough money to justify continuing, but you don't have enough money individually or collectively to hire a studio, produce a CD, and then get it published. So you need to raise, say, $20,000 to do that. So I don't know what CDs go for, probably $20, $30 a piece now. So you decide that you're going to sell CDs for $10 a piece pre-sold. And so you go on to Indiegogo or you go to Kickstarter, you do a little video, you talk about your band, and then you allow people to pre-purchase a CD for $10. You get 2,000 people to send you $10. You have 2,000 customers. You have at $10 times 2,000, you have $20,000. You have enough to go to the studio, to rent the studio, and to produce the CDs that you're going to sell. That's the concept behind a rewards-based program. So there's got to be a product involved. You can't sell equity, you can't sell debt, you can't just simply raise money because of some worthy cause. These are specifically designed and typically limited to organizations, people that want to sell a product. Then there's cause-based funding, and there's a number of different websites out there. The biggest one is one called GoFundMe.com, and cause-based sites are very inexpensive. You do all the marketing to get people to your website. You don't really rely on them to do any marketing for you. Same thing's true with, for the most part, Indiegogo or Kickstarter. Unless you're successful at getting people to your site, they're not going to help you. Now, if you're successful at getting people to your site, they'll place you in a high profile position, and you might get extra from them. But if you don't have your own traffic, they're not going to elevate you. Same thing is true with GoFundMe and other cause-based crowdfunding sites. So if you're trying to do a missionary program and you need some money, or your grandma needs a hip or something like that, the GoFundMe type websites are a good place for you to be able to raise money, where people just give you money, and that's what that's all about. Now there's a whole world of debt-based websites. Personalloans.com, lendingtree.com, peerloans.com. These are what's called microfunding or microloan sites, and likewise, they're inexpensive. It's a little time consuming to assemble your information. Remember, you're getting debt, and debt must be repaid, and typically the only people that go to these sites are people that can't get money from at an affordable rate from a traditional bank or lending institution. So typically you're going to have a higher interest rate associated with this, but it is at least a resource for those companies that are interested in debt and want to go to a crowd environment. Quite honestly, if you're an investor and you're lending money to people through a micro lending site, you're actually lending money to the people that are typically the least qualified to get money. And so it can be very, very iffy. So whether you're wanting to borrow money or lend money, just be very aware that crowdfunding sites are kind of a challenge to deal with. The next is equity-based. And equity-based websites are, there's quite a few of them out there. A couple of well-known ones are equitynet.com and crowdfunder.com. And on an equity crowdfunding website, you're selling equity in your business, ownership interest. You must deal only with accredited investors. So you're limited literally to selling to accredited investors. This is a relatively time-consuming process. It is also relatively inexpensive. Most of these websites will charge you somewhere in the neighborhood of a few $100s a month to have access to placing your digital portfolio or your digital private placement up on their website. You typically must comply with exactly their format for putting information up, and which is not a bad thing, because they do get typically quite a few accredited investors there, so they're good places to go. You also must be very versed with and very familiar with Reg D, Rule 506C, which is the Securities and Exchange Commission regulations that deal specifically with crowdfunding. There's a number of things that you must do that you're prohibited from doing, and so on. So you're gonna want to learn more about that. I actually cover in a little bit greater detail that information later on. Now, generally speaking, the next sort of level of funding, I think, would be considered to be angel investors. Now, angel investors are kind of a unique breed. These are typically wealthy people who have worked most of their life in one or two industries. They've made a lot of money. They might themselves have been founders or equity owners in a company. They've had some sort of a payday. They could very well just be C-level executives that made a lot of money, and they've now retired or semi-retired. And in any event, they're typically very interested in kind of staying in the game. They've made enough money to where they can gamble, and rather than going to some gambling casino, they're gambling on small businesses. They're gambling on small businesses primarily because they enjoy the fact that angel investors are the ones most likely to get 50 to 100 or 200 times their money back. And now that may sound outrageous, but I personally have been involved in starting a business where the very first round investors, people that put in 50,000, got $20 million back, which is a 400 times return. That is not, common, but it's certainly not unheard of. And so angel investors are the kind of people that are hoping to hit one of those 2 or 3 or 400x returns, and they're willing to take risk. And that's one of the great things about angel investors. They tend to be very patient, and they're willing to take risk. There's an estimated 300 and almost 20,000 angel investors in the United States. They put significant money in a large number of small companies every year. They typically fill the gap that venture capital companies are not interested in, which is, dollar amounts of, $10,000 or $20,000 on the low end up to $1 million or $2 million. Now, the average angel investor is typically going to be good for around $50,000, and they'll do 1 or 2 deals per year. And now some are more active, some are less active, but they'll do 1 or 2 deals a year, and it takes about a couple of months to typically from your first meeting with an angel investor to closing. Not the vast majority, but the majority of investments that angels make, they lose money. About 7% of the times that they invest, they're going to get 10 times or more their money back. So it actually kind of works out for them when they do get a big hit. I've had a number of people that are angel investors tell me that 5 or 6 times out of 10 that they invest, they'll lose money. 3 or 4 times, they'll kind of get their money back, so they'll about break even. And about 1 out of 10 times, they'll get 10 or 20 times their money back. And so it's worth it to them. The return is certainly very gratifying to them, but as much as anything, they love the game. They like being involved in small businesses. They like helping small entrepreneurs get established, and they're an excellent source of sort of seed stage first round money. There are a number of angel investor networks out there. In fact, I'm going to show you about a half a dozen in the DFW Metroplex, but you can go Google Angel Investor Network in pretty much any big metropolitan area, Atlanta, Los Angeles, any big city. And you're going to find on Google a list. You just poke around a little bit and you'll find a list of them. But there's quite a few of them out there. In fact, angel investors are very active. This is a set of data. It's a chart covering the time frame from 2010 to 2016, and you can see the bars. The bars represent the deal value, and the left side is the billions of dollars, so you can see the deal value. The right-hand graph shows the number of deals that have been invested in, and angel investors are the yellow line, and you can see that they've been fairly active since the 2010 timeframe. So there's quite a bit of angel investor activity. This is a list of angel investor networks in the DFW area. You can go look up any of these. In fact, if you just Google Angel Investors Dallas or Angel Investors Fort Worth or Angel Investors DFW, you should pretty easily be able to find websites for any of these. And every one of these websites has a process that they invite you to go through on their website. Most of them don't charge you anything to go through the process, and they are inviting you to submit your business plan or your pitch deck. And if you qualify, it'll go through in most cases, it'll go through a review committee that will then invite you. If they like what you have, they'll invite you to come and make a pitch on typically a Saturday at some hotel where they'll have a pitch day once a month, once every couple of months, that type of thing. And you can just go, and typically you'll get about 3 to 5 minutes to make your pitch, 5 to 10 minutes to answer questions, and then you'll be able to to kind of see how that process goes. And if they're interested, they'll come back to you and say, we'd like to talk to you. So there's a variety of different mechanisms in place there. Next, let's talk about venture capital. There are well over 400 venture capital companies in the United States. I think that number has probably risen some since I prepared this graph. Most of them are seeking opportunities in the $5 to $25 million range. Now, most of the venture capital companies will not put in the full amount. They're looking for investments that they can put money in, but they're also going to want to be part of a group of venture capital companies. They're typically not lone rangers or lone wolves that go out and do an entire deal by themselves. So if you're raising $5 million, you're probably going to be looking at, 2, 3, 4, maybe 5 companies to put $1 million in. If you're raising $20 million, you're probably looking at 3, 4, 5 companies to put $5 million in. They do occasionally come in by themselves, but they usually want to do deals with other venture capital companies. They also are pretty discriminatory regarding the deals that they'll do. Most of the venture capital companies will only do about 1 out of 100 deals that are presented to them. The deals go through sort of a funnel staging. About 90% of the deals that they're presented with simply do not fit their parameters. Now, you can to some degree tell what their interests and parameters are by visiting their website, but in many cases, you'll still get rejected because there's some other aspect of your deal that is not going to fit their parameters. So, you go to their website, you look at the parameters, you see what the invitation to submit process looks like. You submit, about 9 out of 10 will they'll just go into the round file, the trash can. You may receive a rejection letter or not. Typically, you do get a thanks but no thanks letter back, but they don't typically tell you the details of why they weren't interested, which of course would be very helpful, but you typically don't get a whole lot of feedback. Now, if you're in one of the 10 deals out of 100 that get a really close look, then they're going to be in touch with you. They're going to have questions. They're going to do their due diligence to try to figure out whether or not you represent really the one that they want to put money in. And so you'll typically get feedback from them because they'll be in touch with you as you go through the due diligence process. Typically about, again, 1 out of 100 gets funded. Now, venture capital activity in the United States is currently pretty high. I say currently. These data points are up to the year 2020. Now, all venture capital investments, whether they're angels or anything else, have been really cut back because of COVID. The unknowns related to what's the shakeout going to be, as well as the fact that this is an election year, are causing deals to be a little bit down this year. We don't have the data yet, but you can see the general trend in terms of investments has been relatively high. Back at the end of the dot-com days, it was extremely high, $66 billion in 2000. 2001 was still good, but that was up to 9/11, and then after 9/11, you saw a significant retrenchment in venture deals up until the period of the 14, 15, 16, and so on. And since 2016, you've seen a pretty steady climb, of course, up until this year. So there's a lot of deals, there's a lot of money out there. Venture capital companies will, most often invest in companies across several stages. They will do early stage, but they're typically more interested in expansion stages. Only about 2% of the venture capital money that is out there goes into really early stage, seed stage. They really tend to prefer, as you're going to see from the series of charts, to get involved once a company has sort of proven its business model. So I have several charts here that represent different sort of perspectives on the venture capital world. This particular chart shows you the stages from grants, angels, seed fund, venture capital, and public markets. And it shows you through the 3 lines that as the risk declines, as the sales start to pick up, then you really reach the point where venture capitalists become interested. In the early stages, when there's a lot of risk and there's little or no sales, then the venture capital companies are typically much less interested. Public markets, of course, are at the later stages when you have a well-established company with high sales volume, risk has become extremely, relatively speaking, extremely low, and then that's when public money becomes available for expansion. Here's another way of looking at the same information. So the amount of money is on the vertical chart side to the left, and the different stages, I'm not sure how easy these will be for you to read, but concept research, then business planning, product development, first commercial deals, fully operational expansion, and ready for IPO. So you can see that you start with seed money, angels, and then venture investments, early stage, and then the first, second, and third actual formal rounds. And then you get to mezzanine. We'll talk about mezzanine in a second, but mezzanine's a word you're going to hear thrown around. This is typically funding that is sort of bridges between late stage startup and early stage maturity, where you're beginning to be of interest to large financial institutions, because that's really what mezzanine money refers to. Here's another example of a sort of a way of looking at how venture capitals fit in. The time to close a deal is on the left, or it's on the vertical, and then the size of the deal is on the horizontal. And so if you need money quickly, then friends and family, and of course your own pocket is zero. Your own pocket, when I say zero, I mean you have immediate access to your own money. Friends and family is the next quickest. Individual angels and angel groups are easier, more quick. I've actually been fortunate to get money from an angel investor within 2 days of meeting him, and when 3 days of being introduced to him, and the very first day I went to do a pitch, he cut me a check and sent me on my way. That's unusual to get same day kind of money, but typically within 2, 3, 4 months, individual angels will often be ready to make a decision. It kind of depends upon, obviously, the individual angel investor. Another way to look at, so venture capital money in this particular chart tends to come in later in the stage. The next chart shows the growth of a company. The dotted line going across the horizontal in the middle is your break-even point. Typically when you're way below break-even and you don't yet have a lot in the way of revenues are just getting started, you're not going to be very interesting to venture capital companies. Angel investors and startup money is going to be your grants and that sort of thing, going to be your first choice. But as you start to get some traction and start to get a steepening growth rate, venture funds will start becoming interested. And then of course you can go through private money, debt money, and mezzanine financing as the size of your company begins to progress. Yet another way to look at this is startup on the left and expansion late stage on the right. Venture capitalists, which are the green bars, are going to be very little interested. About 2% of startup money, seed money, comes from venture capitals. But angel investors really only tend to participate very little in the expansion stage. In the middle, there's a relative balance. Again, the reason is that angel investors are looking for the high risk, high return opportunities. The venture capitalists are typically managing somebody else's money, not their own, and they're less risky. They're looking for better established, and so they're willing to take a less return for a later stage look at the business. Here is a short list of the kinds of things that are really highly important to venture capitalists. The things that they really look closely at are the quality of the management, the degree to which you have a competitive edge relative to your competitors. So do you have experience? Do you have a team that has experience? Do you have a truly valuable product that has a unique selling proposition and the ability to not only build but maintain for a long term a sustainable competitive advantage? Are you in an industry that has a lot of potential growth in the industry? That is going to be a lot more interesting than if you have a product where you're not in an industry where you have a lot of potential growth. You definitely want to have a viable exit strategy, but remember to focus your attention not so much on, somebody's going to buy me, but we're going to be establishing positive cash flow and being open to the idea of an exit in 3 to 5 years. That's the main thing they're going to be interested in, is the probability of you achieving high positive cash flow, and then your openness and willingness to entertain exit options. They know how difficult it is to predict that any particular exit will occur. So focus your attention on that. And then the intangibles. Can you walk, talk, chew gum, and dance a jig at the same time? If you can, the greater the degree to which you have a highly articulate, enthusiastic, hungry, and charismatic presentation, if you speak good language and are articulate, if you communicate well, if you present yourself well, if you're hungry, and if you're able to be charismatic in your presentation, the greater the degree to which all of those factors are present, the more attractive of an investment candidate you will be. Now, as far as where you go to find money, again, you can find a lot of different venture capital companies, whatever part of the United States that you're in. This is a list here in the Dallas-Fort Worth area that was very easy to put together. You can certainly freeze this frame and copy it and go visit these websites, but these are all venture capital companies in the Dallas-Fort Worth area, and every one of them on their website tells you what process they would invite you to initiate to submit your deal to them. And if you are interested, just go do that. But I just want you to understand that it's not hard to find venture capital companies to go talk to.